Hello, clients and friends of MBP Sterling Partners. It's Jamie. I'm back for a recap of the first half of 2023 and an outlook at the second half. Here's our agenda for today, so let's jump right into it. Firstly, let's have a look at the broad market and indexes. Broad is not the way I'd describe the rally that we've seen this year, but robust certainly is. We've had amazing performance out of equities globally for the first half, led by the NASDAQ and Japan. Toronto and the Canadian markets have been no slouch either, with a 6% rise. Almost all the sectors are participating, with the exception of energy. In Canada, we've seen a little bit of a drawdown in energy after the monster year that we saw last year. Bonds and global real estate, they've been muddling along this year after last year's poor performance. We're happy to see something positive, but really we haven't seen a heck of a lot of performance like we have in the way of in the equity markets. With the broad markets on equities, we're calling this theme not so broad. It's really been 7 stocks that have been driving that S&P 500 and that NASDAQ return so high. Apple, Microsoft, Amazon, Meta, Google, Tesla, and NVIDIA have accounted for 3/4 of the return, the 16.9% return that the S&P saw in the first half. We have not seen a divergence like this from the cap-weighted S&P to the equal-weighted S&P like this in quite some time. It would have been an extra 10% to hold one over holding all 500 companies in equal weights, as opposed to holding these behemoths in the big weights that they represent the index. In Canada, we haven't had that divergence. We've seen more or less similar performance between one or the other. We don't have these mega cap leaders that the US is having. So let's take a little bit of a deeper look into these mega caps. What's happening here? I've included the top 10 stocks in the S&P 500 by weight. 8 of them are higher for the year. Only 2 of them have actually lost value. But what's interesting to see is the multiple expansion. So we look at price earnings multiples as a way to price stocks. All of them but 2 have had their price earnings ratios expand. But interestingly, only 3 have actually expanded their earnings as well. So taking a look at NVIDIA, which has been the big returner for the year, we've seen both their earnings and their price earnings multiple expand. Those things have combined for almost a 200% increase in NVIDIA in the first half. So watching earnings and multiples expand at the same time is really a powerhouse for the way that equities perform. But we do find it interesting that multiples have expanded while earnings have not followed suit. Now, equity markets will generally lead and not follow. They are leading indicators. So we won't suppose that earnings won't catch up with what equities have priced in. We just do notice that there seems to be a lack of earnings growth into this rally that we've seen so far this year. In the TSX, we've seen a much more modest increase in multiples. It's trading at 13.7 times now, which historically is almost cheap. Looking at the earnings expectations in back to the US market here, we can see that those expectations have been declining. So both in the 2023 and the 2024 estimates for earnings for these 500 companies have been declining. They're stabilizing now, but analysts have been taking down their earnings estimates for the better part of a year. And this is underlying that the market has rallied for the last 6 or 7 months. So the markets have been rallying in the face of declining earnings estimates, just like they had started to decline as earnings estimates were still rising at the end of 2021 and into early 2022. So investing is hard. You can't just watch what the earnings estimates are doing and follow along. These markets will lead even the analyst estimates who supposedly know the most about how these stocks work. Let's have a look at interest rates and rate expectations. This has been a round the world whirlwind, however you want to call it, trip since this rate hike cycle has began. A quarter ago, we would have said it looks like the Fed is done and the Bank of Canada are done in raising rates. We had recently had Silicon Valley Bank collapse and what we'd call a negative growth shock because of the banking sector in the US. That is in the rearview mirror now, and the focus is on inflation. And bank rates have both gone higher. Both the Fed and the Bank of Canada have been lifting their rates since that time, and the market is expecting even more. In Canada, we see 1 or possibly 2 more hikes on the horizon. And in the US, the market is pricing in another hike. Now, keep in mind, market expectations were wrong before. We have no reason to believe that they're going to be right now, but we also don't have a reason to believe that they're going to be wrong. This is just what the market is thinking given the current data. What's driving these expectations? Well, inflation has remained sticky, stickier than the central banks would like. We see on the left here the inflation chart is rolling over, so the annual headline inflation is coming off both in Canada and the U.S. But you'll see right in the dotted lines at the bottom a little bit of a divergence at the end of those charts where Canada inflation has remained sticky, whereas the US is still somewhat moderating in that 2 to 3% range. The opposite is true for unemployment, the other big factor in setting Bank of Canada and Federal Reserve policy. In Canada, we've seen the unemployment rate tick a little bit higher, and the employment reports have come in a little bit weaker. Last week's report notwithstanding, it was a blowout jobs number for Canada, but that's a very volatile series. Whereas in the US, employment remains very robust. The unemployment rate remains low, and US payrolls continue to come in stronger and beat expectations in the markets. So we've got a bit of a dichotomy between the two economies, but the end result is that central banks have promised to keep rates high, keep them at the level that they're at now, and they continue to battle what they believe is a persistent inflation and very strong employment. So how the bond market's reacting to that? Well, we've seen rates climb. And this is very interesting because the yield curve is so inverted and it continues to get even more inverted given that the short rates are climbing faster than the long rates. So you'll see on the left here, 3-month and 2-year yields have climbed faster than those 10-year yields, both in Canada and the US. And that is leading to even more inversion in the yield curve. Now, we watch that closely because the yield curve historically has been a very good predictor of recessions. The timing, maybe not so much. But generally speaking, an inverted yield curve has led to a recession more times than it hasn't. So what else do we look for in our outlook for the second half? Well, where do we want to be investing? We'll give a green light to bond yields. The orange line here is a proxy for bond yields. We always want to buy when yields are high. That means prices are low. And we can earn decent returns by either buying when that line is high and selling when it's low, or just by buying when yields are good and clipping coupons. Right now, we see a very good entry point for high quality bonds. We've seen those yield charts rising several times here. It's a good time to be getting into those markets. The S&P 500, as we mentioned, it's trading over 20 times earnings now. So I would not call that very good value. Historically, the 10-year average for that has been 18 times. So we're trading north of that. A lot of that is driven by those big names that are at the top of the index. So underlying the index, we do see a lot of value, and we're calling this a stock pickers market. And trying to find value from amongst those names is actually easier once you take out the big tech heavyweights. The TSX trading at a quite healthy 13.7 times. That's historically been a very good entry point. Over the past 10 years, we've seen that trade north of 16. So valuations for bonds and stocks in Canada look good. In the US, they look less good, so we remain a little bit cautious. But our view remains that it's still a good time to get invested. A quick note on cash. The cash rates in this market and cash equivalents have been very good. So it's worth getting your cash invested. For those of you that are in the GIC market, we're seeing lots of attractive alternatives to GICs that are both yielding more and have more liquidity than GICs, giving you a little bit more flexibility if you need to get out of that cash equivalent or get out of that GIC prior to its maturity date. Bank issued extendable notes we're seeing in the high fives in terms of interest rates. Treasury bills, some of them, depending on the tenure, are through 5% yields. And we're seeing lots of short-term investment grade bonds in the 4.5% to 5.5% range. So give us a call if you're interested in some of those cash rates. Finally, it's a good time to be investing cash again. Well, thanks everybody. I've enjoyed bringing the update to you. If you have any questions, please feel free to reach out. We always love our calls from our clients. Hope everybody has a good day.